Have you ever wondered if you're truly maximizing your returns with SCHD? What if I told you that certain stocks within SCHD are significantly undervalued right now, and cherry-picking just a handful of these dividend aristocrats could potentially double your returns over the next decade? In this video, I'll show you exactly which undervalued stocks within SCHD have the highest potential for both dividend growth and price appreciation. I'll also reveal whether SCHD's methodology is actually optimal for long-term investors in today's market, or if there's a better way to leverage this popular ETF. Stick around until the end, because I'll break down a step-by-step strategy that could potentially enhance your dividend portfolio by targeting these hidden gems within SCHD at precisely the right time. Hey everyone, welcome back to the channel. Today we're doing a forensic examination of the Schwab US Dividend Equity ETF, better known as SCHD. Here's everything I'll cover in this video. A deep dive into SCHD's current holdings and why some are significantly undervalued. How SCHD's methodology affects its performance during different market conditions. A sector-by-sector breakdown to identify where the biggest opportunities lie. How SCHD compares to alternatives like DGRW and SPYD in terms of risk-adjusted returns. And most importantly, my expert strategy for cherry-picking the most undervalued dividend stocks from within SCHD. This isn't just another SCHD overview. I'm going to show you how to take your dividend investing to the next level by understanding what's happening under the hood of this popular ETF. Let's dive in. Here's the challenge most dividend investors face with SCHD. While it's widely regarded as a safe haven ETF with quality holdings, you're still buying the entire basket of 101 stocks, some of which are fairly valued or even overvalued, while others are significantly undervalued. The problem is that SCHD's methodology, which focuses on financial strength and dividend history rather than current valuation, means you might be missing opportunities to maximize your returns by strategically targeting the most undervalued components. Many investors simply buy SCHD for its impressive track record and 4.05% dividend yield without understanding exactly what they own or how to optimize their approach. What if you could keep the quality aspects of SCHD while enhancing your returns by focusing on its most undervalued components? The solution is to perform a forensic analysis of SCHD to identify which of its holdings offer the best value proposition right now. Let's start with some key stats about SCHD based on the latest data. As of April 2, 2025, SCHD currently has $66.47 billion in assets under management. It offers a 4.05% dividend yield. Its expense ratio is just 0.06%. It holds 101 total stocks. Its top 10 holdings make up 41.09% of the fund. Its 5-year performance shows a total return of 57.42%. Its all-time return since inception is an impressive 208.04%. When we compare this to alternatives like DGRW and SPYD, we can see significant differences in approach. DGRW has a much lower yield at 1.67%, but has delivered higher 5-year returns at 84.16%. Meanwhile, SPYD offers a higher yield at 4.59%, but has fewer holdings at 79 stocks and less concentration in its top positions. To truly understand where the opportunities lie within SCHD, we need to dig deeper into its holdings, sector allocations, and methodology. Let's break down how SCHD works and identify where the most significant undervaluation exists among its holdings. SCHD tracks the Dow Jones US Dividend 100 Index, selecting stocks based on 10+ years of dividend payments. High dividend yield. Strong fundamental metrics, cash flow to debt, ROE, dividend growth. Market capitalization. This methodology favors established companies with financial health but doesn't directly account for current valuations. That's our opportunity. Looking at SCHD's current top holdings: Coca-Cola, KO, 4.47%, ConocoPhillips, COP, 4.46%, Verizon, VZ, 4.31%, Altria Group, MO, 4.25%, Lockheed Martin, LMT, 4.21%. Analyzing through a valuation lens, Verizon stands out with a forward PE well below its 5-year average and a 6% plus dividend yield, making it potentially undervalued within SCHD's top holdings. SCHD's sector allocations show significant exposure to consumer staples, healthcare, energy, and technology. Our analysis reveals that certain healthcare and energy companies within SCHD are trading at substantial discounts to their historical averages. If Harry simply buys SCHD, he gets all 101 stocks. But by identifying the most undervalued components, he could potentially enhance his returns significantly. Historical performance analysis. SCHD has delivered 57.42% over 5 years and 208.04% since inception, 2011, translating to approximately 9.5% annually over 5 years and 11.5% since inception. Breaking this down, dividend yield, 3 to 4% annually. Dividend growth, 8 to 9% annually. Price appreciation varies significantly yearly. Compared to the S&P 500's 18.1% annual return over 5 years, SCHD has recently underperformed. However, during market downturns and early recovery phases, SCHD has shown stronger relative performance. Analyzing rolling 3-year returns shows SCHD tends to outperform during early recovery phases following corrections, rising interest rate environments, periods of economic uncertainty. This pattern suggests strategic timing for targeting undervalued components within SCHD. Now, let's explore 3 distinct investment strategies involving SCHD and its components. Strategy number 1, the CoreSatellite approach. In this strategy, Harry uses SCHD as his core dividend holding, 70 to 80% of his dividend allocation, while targeting 3 to 5 undervalued individual stocks from within SCHD as satellite positions, 20 to 30% of his dividend allocation. Currently, based on our valuation analysis, the most undervalued components of SCHD include Verizon, VZ, with its 6% plus dividend yield and PE ratio below historical average. AMGN, AMGN, trading at attractive valuations despite strong pipeline and cash flow. CSCO Systems, CSCO, offering value in the technology sector with a solid dividend. This approach gives Harry broad exposure to quality dividend stocks through SCHD while allowing him to enhance potential returns by overweighting the most undervalued opportunities. But wait, before you rush to implement this strategy, let me show you 2 more approaches that might work even better depending on your situation. Strategy number 2, the valuation-triggered approach. In this more sophisticated strategy, Harry maintains a watch list of all SCHD components and establishes valuation triggers for potential investment. For example, he might set a rule to invest when a quality SCHD component falls to a PE ratio 20% below its 5-year average while maintaining or increasing its dividend. This approach allows Harry to systematically identify undervalued opportunities within the SCHD universe. The benefit here is that Harry is using SCHD's rigorous screening methodology as a starting point, but adding his own valuation filter to enhance returns. Strategy number 3, the sector rotation approach. In this strategy, Harry identifies which sectors within SCHD are most undervalued relative to their historical averages and overweights those sectors in his portfolio. Currently, based on our analysis, certain healthcare and energy stocks within SCHD appear undervalued compared to their historical norms. By temporarily overweighting these sectors, Harry can potentially capture additional returns as these valuations normalize. Now, let's compare SCHD's methodology and risk-adjusted returns against its main competitors, DGRW and SPYD. SCHD focuses on financial strength and dividend history, resulting in a portfolio of 101 stocks with significant concentration in its top holdings, 41.09% in the top 10. Its holdings tend to be established companies with strong balance sheets and dividend records. DGRW takes a different approach, focusing on growth potential and quality factors. With 304 holdings and 36.77% in its top 10, DGRW includes more growth-oriented names like Microsoft, 7.80%, Apple, 4.67%, and Nvidia, 3.08%. These are stocks you won't find in SCHD. SPYD simply focuses on high current yield, with 79 holdings and just 15.94% in its top 10. Its sector allocation heavily favors finance, 37.28%, and utilities, 21.39%. When we compare risk-adjusted returns, Sharpe ratio, we find SCHD offers moderate volatility with strong total returns. DGRW provides higher growth potential but with slightly higher volatility. SPYD offers the highest current yield but with potentially lower long-term total returns. The key insight here is that SCHD's methodology creates a unique portfolio that balances yield, quality, and growth. But it doesn't explicitly account for current valuations, which is where our opportunity to enhance returns exists. Before implementing any strategy to target undervalued components within SCHD, we need to understand the risks. SCHD's volatility metrics show it's slightly less volatile than the broader market, with a beta around 0.9 and a standard deviation of 15.66% over the past 3 years. This relatively lower volatility is due to its focus on financially strong companies with consistent dividends. However, SCHD does have sector concentration risk, with significant allocations to consumer staples, healthcare, energy, and technology. Any industry-specific challenges in these sectors could impact SCHD more significantly. When analyzing how SCHD performs during different economic cycles, during recessions, SCHD tends to outperform the broader market due to the financial strength of its holdings. During inflationary periods, SCHD has demonstrated resilience, particularly when its holdings have pricing power. During rising interest rate environments, SCHD's performance has been mixed, as higher rates can pressure some dividend stocks but benefit others, like financials. Understanding these patterns helps us identify when cherry-picking undervalued components might be most effective. Technical details: SCHD's methodology. To find opportunities within SCHD, we must understand its rebalancing and reconstitution process. SCHD rebalances quarterly and reconstitutes annually in March, screening stocks based on market cap, minimum $500 million, dividend history, 10+ consecutive years, yield, and fundamental strength indicators. This annual reconstitution creates opportunities, as stocks added to the index often see positive price movements, while those removed sometimes become undervalued. SCHD's low turnover rate, 20 to 25% annually, makes it tax efficient and means stocks typically remain unless fundamentals deteriorate significantly. Future outlook: recent tariff wars have created market volatility and valuation disconnects, perfect for dividend investors seeking undervalued stocks. Key factors impacting SCHD going forward: interest rates. Rising rates may pressure dividends, but SCHD's financially strong companies should weather this well. Inflation. SCHD's consumer staples with pricing power make excellent inflation hedges. Economic growth. Quality dividends typically outperform in slower growth environments. Sector trends. Tech, healthcare, energy, and financial evolution will impact holdings differently. In this volatile market, our strategy of targeting undervalued SCHD components becomes increasingly valuable. Expert strategy: cherry-picking undervalued SCHD components. Let's put everything together into a comprehensive strategy for identifying and investing in undervalued stocks within SCHD. Step 1. Screen SCHD holdings for valuation metrics. Find stocks trading below their 5-year average PE ratio. Target dividend yields above their 5-year average. Compare price-to-book and price-to-cash flow ratios against historical norms. Step 2. Verify quality indicators remain strong. Check debt-to-equity ratios haven't deteriorated. Ensure dividend coverage ratio remains healthy. Confirm ROE and cash flow trends are stable or improving. Step 3. Establish entry points. Set target prices based on historical valuation ranges. Create alerts for when price targets are reached. Step 4. Determine position sizing. Allocate more to stocks with greater undervaluation. Maintain sector diversification. Step 5. Establish exit criteria. Define when a position has normalized in value. Set profit targets and recycling plan for capital. Based on our analysis, Harry might maintain 70% in SCHD for broad exposure. Allocate 10% each to undervalued components like Verizon, VZ, AMGN, AMGN, and Cisco, CSCO. This approach provides SCHD stability while potentially enhancing returns through tactical allocation to undervalued components. SCHD provides a solid foundation, but targeting its undervalued components can significantly enhance your returns. Remember these key points. SCHD builds quality but doesn't screen for current valuations. Significant opportunities exist within SCHD's undervalued holdings. A CoreSatellite approach offers the best risk-adjusted strategy. Regular analysis identifies new opportunities as markets shift. The best dividend strategy requires understanding what you own and recognizing value when it appears. If you found this analysis helpful, hit like and subscribe.